If you don't understand how money works, it will always work against you. Most people think investing is complicated. They hear words like stocks, bonds, or mutual funds, and immediately zone out. But here's the truth. Investing isn't just for the rich. It's how regular people become rich over time. So in this video, I'll break down the basics of investing in plain English. By the end, you'll understand how to grow your money, protect it, and make it work for you, not the other way around. Introduction. Why you must learn investing. You see, every dollar you earn is like a tiny employee. You can either let it sleep in your bank account or send it to work and make more dollars for you. That's what investing does. It multiplies your money through ownership, lending, and compounding. And the sooner you understand it, the faster you can achieve financial freedom. So let's dive into the 4 basics. Stocks, bonds, mutual funds, and interest types. 1. Stocks. Owning a piece of a company. When you buy a stock, you're literally buying a small piece of a company. Think of Apple, Tesla, or Amazon. If these companies grow and make profits, your slice of ownership becomes more valuable. There are 2 main ways to make money with stocks. Capital gains. When you sell a stock for more than you paid. Dividends. When the company shares a portion of its profits with you. Example, you buy 10 shares of Apple at $100 each. Total, $1,000. If Apple's stock price rises to $150, your investment is now worth $1,500. You've made $500 just by being an owner. Stocks tend to give higher returns, but they come with higher risk, because prices can rise or fall daily. 2. Bonds. Lending your money now. If stocks are ownership, bonds are loans. When you buy a bond, you're lending money to a government or company. In return, they promise to pay you back later, plus interest. Bonds are usually safer than stocks because you're guaranteed regular interest payments called coupon payments. However, their growth potential is lower. Example, you buy a $1,000 bond that pays 5% annual interest for 10 years. Every year, you get $50 in interest, and after 10 years, you get your $1,000 back. Bonds are great for stability, especially when the stock market gets rough. 3. Mutual funds. Team investing now. What if you don't want to pick individual stocks or bonds? That's where mutual funds come in. A mutual fund is like a basket of many investments, stocks, bonds, or both. It's managed by professionals who decide what to buy or sell for you. Benefits. Diversification. Your risk is spread across many companies. Convenience. You don't have to research individual stocks. Example, if you invest $500 in a mutual fund, you might own tiny pieces of 100 different companies. That means if one company fails, your entire investment isn't wiped out. Mutual funds are a smart choice for beginners and long-term investors. 4. Types of interest. Simple versus compound. This one is the real wealth builder. Simple interest means you earn interest only on your original money. Compound interest means you earn interest on your interest. It snowballs over time. Example, if you invest $1,000 at 10% simple interest for 5 years, you earn $500 total. But with compound interest, you'd earn over $610. It may not sound like much at first, but over decades, compounding turns small investments into massive wealth. That's why Einstein called compound interest the 8th wonder of the world. Bonus, the power of starting early. Here's the golden rule. Time greater than timing. It's not about catching the perfect stock or market moment. It's about giving your money time to grow. If you invest $300 per month starting at age 25, you could retire with over $1 million by 65, assuming an average 8% return. But if you wait until 35, you'll end up with less than half that. The earlier you start, the more compounding works in your favor. How to get started? Simple steps. Here's a quick 5-step plan to start investing smart. Set a goal: retirement, wealth, or passive income. Know your why. Build an emergency fund. Always keep 3 to 6 months of expenses in cash. Pay off high-interest debt. Don't invest while drowning in credit card interest. Pick a platform. Use trusted U.S. brokers like Fidelity, Vanguard, or Charles Schwab. Stay consistent. Invest monthly. Don't panic when markets dip. That's when wealth is built. Real talk. Investing isn't gambling. You're not throwing darts. You're building ownership in the world's most powerful companies and economies. When you invest, your money is working 24/7, even while you sleep. The key is patience, consistency, and learning the rules of the game. If you learned something new today, hit that like button. It helps more people understand how money really works. Comment below, what's your biggest question about investing? I might cover it in my next video. And don't forget to subscribe for more financial wisdom. We talk about money, investing, and mindset every week to help you build your dream life. Remember, you don't have to be rich to start investing. You have to start investing to become rich.